Hello. So I just made a video about Microsoft and its earnings report. I will be linking that at the end of this video. But in this one, we're going to talk about Alphabet, which actually misses on earnings and revenue for the second quarter. And Microsoft didn't miss, but it did decline about 6%. And it's the same thing, the same story with Google right now, with Alphabet. It's down about 6.6% in the after hours market. We're going to see what's going to happen when the market's open, but it looks like we're going to have some decline here for the Nasdaq tomorrow. At least that's what the futures are telling us. And we're seeing some companies, even Meta, for instance, getting affected from this kind of decline. Now, if you take a look at the earnings report, let's see what happened here with Alphabet. So they missed on earnings and revenue, and we can see the exact details here in this very nice little description over here. The earnings per share that the company did was 1.21 versus $1.28 that was expected over here. So that's a pretty significant decline. In terms of revenue, 69.69 billion, so about 70 close billion over here versus 69.9. So that was actually expected. Another miss over here. The YouTube's advertising revenue has been going down as well, 7.34 billion versus 7.52 billion that was expected. I have seen that in my account too. The amount that the advertisers are paying has been going down recently. And so this is again expected because in this current decline of the market, fewer advertisers are going to be willing to pay a lot of money to attract new customers. They're going to be trying to spend less. And this makes a ton of sense in this current economy that has been decimated. And this is why you are looking at advertising revenue going down. Same thing with the Google Cloud revenue also going down 6.28 billion versus 6.41 that was expected over here. So the traffic acquisition costs are also down a little bit. It looks like the costs are getting cut down a little bit from Alphabet as well. Another thing that's going to be expected, of course, in this current climate. Revenue growth slowed to 13% in this quarter from 62% a year earlier, when the company was benefiting from the post-pandemic reopening and consumer spending was on the rise. Of course, you cannot expect this kind of an increase. 13% is actually pretty nice for the quarter. It's actually very nice, I'd say. Again, you cannot expect the 62% to keep happening. So I think that 13% is actually very, very fair for a company of this size, pretty much. Now, currency fluctuations also played an important role, as you can understand here. Advertising revenue increased just 12% to 56.3 billion. Frankly, I didn't even expect that there would be an increase here, so there's still an increase in terms of advertising revenue, which is nice to see. But the most notable one was the deceleration in the YouTube division, where sales rose 5% after jumping 84% in the same period a year ago. So still an increase, but again, you cannot compare with 84% in the same period a year ago. Again, that has a lot to do with the economy. Understandably, we're going to be seeing these kinds of declines over here. And overall, you will see here that also Google Cloud fell short of revenue expectations, lost 858 million during the quarter. Now, the cloud division is trying to take share from Amazon, of course, web services, and Azure, Microsoft, that we examined a little bit earlier. I don't know whether they're going to be able to do that, but to me, Alphabet is mostly and should mostly be concentrated on advertising. And of course, if they do well with the cloud as well, so be it. Of course, that would be a nice addition to the portfolio of shareholders. And the headcount actually rose 21%. So Alphabet is still actually hiring employees, and quite a lot of that, 21%. So that's quite a lot. However, the company said last month it will slow down the pace of hiring and investments through 2023. And this is one of the reasons why we're potentially going to be seeing an economic, if not collapse, we're probably going to see a slowdown in 2023. So I do expect 2023 being a year of sort of like average expectations, frankly. Maybe at the end of 2013, we're going to be seeing an increase in activity, but I do expect that we're going to be having quite a few months where the economy is going to be down for a while. Especially when the whole world pretty much is governed by governments that do look to pretty much destroying economies right now. And going forward, the very strong revenue performance last year continues to create tough comps that will weigh on year-on-year growth rates of advertising revenues for the remainder of the year. So again, telling us that this kind of climate is going to be a headwind for Google, for Alphabet, and pretty much they're expecting some decline. They didn't provide a revenue forecast here, but analysts expect growth for the year of 14%, which is still pretty nice as well. Like if this happens, that's pretty great growth. 14%, very, very significant for the year, especially for this kind of year. So that's nice to see. Now let's go back to our tool. Remember that you can gain access by becoming a Patreon. All the links are in the description box below this video. But we can see what the company has been doing. They are going to be down about 37%, it looks like, over here after the market opens tomorrow. They have been at 98 bucks before. They started climbing a little bit, but then now it looks like they're going back down again. So you'll see that, what was it, like Friday? Last Friday that was, like 12 days ago, they were at 97 bucks, frankly. And so it looks like they're probably heading to a similar territory after the market opens tomorrow. Now you will see that the price to earnings is near 20 for both PE and price to free cash flow as well. But the company has been buying back shares and will continue to buy back shares, which is nice to see. Very, very nice to see, especially as a shareholder. You do want them to be continuously buying back shares, especially as these go down in value. And it's a stellar company. Again, the same thing with Microsoft here. If not even better, frankly. They have been increasing their top and bottom lines at an incredible pace over here. And their margins are not as great as Microsoft's, but still pretty great, sitting at 24% right now. They may go down a little bit, so in the tool, I'm going to be trying some lesser margins as well, just to see what we're getting out of this one. Now, if we take a look at the financial statements, you will see that the company's revenue from 111 billion to 257. And remember what we examined in the article, we're expecting 293. It looks like for the upcoming year, pretty much. So pretty nice increase over here, following pretty much on pace with what the company has been doing in most of these years. So they are not really that much affected, frankly. They haven't been yet, at least. And in terms of the net income, 12 billion to 76, another one that increases the top and bottom lines incredibly well over here. Google, that is, on par with what Microsoft has been doing as well. Also, like having like a sevenfold increase from 5 years ago, which is insane, absolutely insane. The balance sheet tells us a story of a company that is increasing their money and assets pretty much amazingly well. Total equity of 152 growing to 251. Amazing growth here in the last 5 years. And the total liability sitting at 108 billion. But if we take a look at the cash flow over here, you will see that this is a super solvent company. Their last year's free cash flow sitting at 67 billion, so it takes a year and a half or so to pay back all their liabilities that the company has, which is insane. Very, very solvent company, very little debt here, and no troubles with cash, which is especially important, understandably. In terms of operating cash flow, 92 billion over here after the adjustments for stock-based compensation, which is a big thing, of course, among these companies, the Bay Area companies, and depreciation amortization is another one. And you will see that the company has capital expenditures of 25 billion here. And of course, repurchasing common stock more and more. As you'll see, pretty much repurchasing more and more every year. And as the company stock price goes down, I'm pretty sure they will keep purchasing even more. They do have about 21 billion also in cash right now. Very nice things to see here for the company, but what about the price to pay? It's a company that I already own, and we're going to examine how much it would make sense to pay for it today. What would be like the top and the high and the low price? And so the revenue growth of the company has been, for the most part, sitting at 23, 24%. Last year they did 40, as we saw, 41. But we have to go lower. We know that they're going to be doing 14%, it looks like, next year. But I'm going to go even lower. I'm going to go 8, 10, and 12. So be even more conservative here. Net income margins, they're sitting at 29%. I'm still going to go a little bit lower because we potentially expect some decline in advertising, which could cause lesser margins too. So I'm going to go 22, 25, and 28. In terms of free cash flow margins, similarly to Microsoft, they're doing something near 100. So we're going to go 90. We're going to go use the same 95 and 100. An annual return of 13%. So is this a buy right now? Let's take a look. And as you'll see with these very conservative, pretty much estimates here, the medium price for the stock to pay right now would be 95 bucks, which after the market opens, it's going to be like 97 to 98. So it's very close to that price. And the high one is sitting at 122, with the low one being at 73. Remember that just because you see a red over here doesn't mean that it is not a buy. What we do want to take into account is what kind of company we're buying as well, and what kind of growth this company has. We're going to take into account what kind of margins this company has, because both of these factors play a significant role to how much money is given back to investors. Because obviously, when the company grows a lot, then the money, the profit that they're going to be making will more than likely grow likewise. And also, if the margins are high, they're making more money out of the revenue, out of the product that they are selling or the services that they are selling. And this is exactly what we want from these companies. And also, we have a company that is extremely solvent here. Like they have tons of cash and no real issues with money, frankly. They don't have a lot of debts, they have great returns. So things are looking amazing here for this company, apart from the fact that we have the economic headwinds, of course, which could potentially maybe take it even lower. So, if you're willing to wait and you have some cash on the sideline, why not? I mean, it could potentially go even lower. But this current price that's gonna be at tomorrow, like 98 bucks, and even at this current price, 105, both prices I would be very, very interested in buying, in entering Alphabet over here. Because remember, I also used very conservative growth numbers as well. I went down in margins, I went down in revenue growth. So we are seeing that this company is obviously pretty great, and it definitely deserves someone adding it to their watch list and potentially even purchasing it even right now, as it's sitting at 98 or 97 bucks. I think it's a fantastic opportunity. And could it go lower? Of course. I mean, in this current market, all of these companies could go lower. So again, if you are interested in waiting, and if you are willing to wait, you could potentially get better prices. Now, I'm not an oracle. I don't know if that's going to happen, but based on what is happening in the current economy, it does look that we can get even better prices for this one. So while somebody could start accumulating, and still be very much in the green for the upcoming years, because this is already quite cheap for what it is. Maybe waiting it out a little bit, or averaging down as it's going down, it may not be a bad idea at all. But thank you for watching. Remember to leave a like and subscribe if you're new around here, and I'll see you in the next video. Bye bye.